Hello, everybody. I'm Ken Leon, Director of Equity Research at CFRA, and thank you for joining us today for what we expect to be a great presentation on the weighty issue on stock market and technology. For those listening in, you can also on the handout see the slides, and then through the presentation, you can also use the chat box to ask questions. Next slide, please. So our disclaimer here, of course, is that this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. Next slide, please. With me today, we got a great lineup today. Sam Stovall, our Chief Investment Strategist, Vincent Randazzo, Chief Market Analyst, Angelo Zino, Head of Technology Sector, and Todd Rosenbluth, Head of ETF and Mutual Fund Research. Next slide. CFRA Research has evolved to be an incredible platform, a global platform offering market strategy, offering technical research, most recently with the acquisition of Lowry Research, which Vincent came from, ETF and mutual fund research with world-class coverage and data, and a methodology that's forward and looking versus backward looking, ETFs, and you'll hear that from Todd. And underneath that is a large foundation of fundamental research that we have covering 1,500 global companies on a qualitative basis and significantly higher, 25,000 on a quantitative. Angelo Zino and myself are part of that fundamental research team. And to be noted here, and the additional IQ of CFRA is our forensic research, that ability where our fundamental research team can collaborate and see diagnostics not only on industries, but also on companies. And also importantly is taking ideas and doing deep analytical research and insights in thematic research, which are on market scope advisors, and they're there every day, which generally help investors and advisors think about current trends and how to put them into action and performance. Next slide. So for today's agenda, we're going to first start with Sam on the weighty issue, the market perspective, move to Vincent on the market technical outlook, and then bring it down to Angelo to speak to the two sectors, technology and communication services, and finish up with Todd on the actionable side of ETF and mutual fund views. So with that, let me turn it over to Sam. Good morning.
Good morning, Ken. Good morning, everybody. Thanks for joining us. What I'm going to be talking about today is whether history shows that sector weightings are a good indication of market tops. So let's take a look at the first slide. I think many people who have been following the market for quite some time know that over the long haul, it's the equal weight S&P 500 that has outperformed the cap weighted 500. Over the last 25 years, it has done so by about 150 basis points per year. Yet when we look to the 3-year, 5-year, and 10-year period, the cap-weighted 500 has actually done better than the equal weight 500, causing investors to scratch their heads and sort of wonder, gee, what's going on here? With it being so top-heavy now, is that an implication that we are in a time that is similar to what happened back in the bursting of the tech bubble? Let's go to the next slide to take a look at what the weightings are today. These are the top 10 stocks in the S&P 500 by market capitalization. And the top 10 currently account for 28% of the S&P 500's market value. So obviously that's a big concern. And you can see on the right-hand side, 10 of the 11 sectors and what their weightings are overall. The only one that's missing is energy because it's about 2.5%. But we see technology is the largest at 28%, healthcare is second at 14%, and so on. But let's keep this 28% number in mind when we go to the next slide. Because what I do here is compare the top 10 stocks in the S&P 500 by their market cap as of the end of March of 2000. Reason being that the market peaked on March 24th of 2000 before falling into a 2.5-year bear market that shaved nearly 50% off of the value of the S&P 500. And what we see here is that the top 10 stocks represented 27%. Technology was in front as it is today, albeit with 5 percentage points of additional weighting back then. But we can see of these 10 sectors, and there were 10 because real estate was part of financials at that point, that we do find that they can be a bit top heavy. But by itself, is that a cause for concern? Let's take a look at the next slide, and what we'll see is the S&P 500's weighting by decade. What I'm showing is from 1970 to 2020, a snapshot of end of year weightings for these sectors. And what we find is with the yellow shading showing the smallest sector and the blue shading showing the largest sectors, yeah, there have been times when we've had 20% or higher exposure to a particular sector. 1980, we had energy. 2005, just before the financial crisis, it was 21%. Technology at close to 20% in 15, and almost 28% currently. So what we typically find is that, yeah, some sectors do end up being fairly large. But again, is that a reason? Is there sort of a warning signal that says if we get too lofty, does that imply that a market decline is around the corner? Let's take a look at the next slide. And what I'm showing here are 3 things. First off, the blue line is the percent of the S&P 500 based on the 2 top sectors. The red line is the weighting within the S&P 500 of the 10 largest sub-industries, and there are currently 124 sub-industries in the S&P 500. And then the orange shadings. The short ones are for corrections, meaning 10 to 20% declines, and the tall ones are for bear markets, which are 20% or higher. Now, certainly investors get the impression that a large exposure to 2 top sectors is a cause for concern, because we see back in December of 1999, heading into early 2000, that's exactly what happened. We had tech and telecom were the largest, representing 48% of the S&P on a cumulative basis. But if you follow your eye on that blue line, you'll find that we had another bear market in 2007 in which the sum of the 2 largest sectors was well below where we were back in 2000. Also, we find similar readings for the corrections of 2008, looking at the correction of 2011, ditto for other corrections in 15 and 18 and so forth. So what I'm really finding is that while there could be some examples in which a large sum preceded a market decline, the reverse is not always true, where large declines end up signaling a market sell-off. Let's take a look at the next slide, which is sort of an intro as to what Vincent Randazzo will be talking about from a pure technical perspective. That leadership is one thing, breadth is another. What is breadth? Well, breadth is participation. Why is that important? Well, here is a simple graphic that says a carriage can be pulled faster and farther when you have 6 horses than when you have only 2. So the greater the number of participants that are in an uptrend tends to be probably a greater indication of what the market is likely to do than simply looking at the sum of the weightings of the top 2 sectors, top 10 sub-industries. Let's take a look at the next slide to see where we are right now. Well, one measure of breadth is looking at the percentage of the 147 sub-industries in the S&P 1500, which is the large cap 500 plus mid cap 400 plus small cap 600. And you see that a recent reading was The 10-week or 50-day moving average was at 39% versus its average of 59% over the last 25 years. And the longer term moving average was 73%, dropping toward its longer term average of 64%. So certainly breadth is very important, and probably more important simply than looking at the sum of the two largest sectors. Let's go to the next slide to show how different today is from 2000. In 2000, tech was the largest sector, but it also had the highest PE on forward 12-month earnings estimates. We thought that, markets thought that tech was cheap at 57 times forward 12-month earnings, whereas today that number is half that. We look at communication services, which was trading at close to 29 times forward estimates. Today that number is 23, and this is apples and oranges because back then telecom services was the more staid long distance and wireless companies, where communication services today is a much higher beta group. Why don't we go next then to the summary to basically say that wide breadth is important for furthering a trend. Narrow breadth usually results in rotation or, worse yet, retreat. Today's stock and sector dominance, yes, it's reminiscent of 2000. However, valuations were more of a bear market driver back in 2000, I think, than they are today. So as a result, our belief is, and you will hear about them this morning, that opportunities remain for tech and communication services, even with the concentration that we're looking at today. So with that, I will turn it over to Vincent, who will go deeper into the technical analysis.
Great. Thanks, Sam. A lot of great perspective there, and I think a good segue into my focus, that is what a stock market bubble looks like under the surface of the price indexes. So if we can go to the first slide, I can show you where we're going to start, and hopefully it catches your attention. So as Sam rightly alluded to, the problem with using price and by translation market capitalization or sector weighting to identify bubbles is that there's really no firm way to define a bubble, right? Especially one at a critical juncture. You know, by definition, these advances just carry much further than almost anyone expects, to the point where even the non-believers get sucked into them by the end. And this is why looking at what's under the surface is actually the more important part, specifically in identifying when an accelerated uptrend starts getting dangerous, right? So beyond the massive price increases, another important commonality among bubbles, since all market tops are processes, not events, is the long degradation of stocks participating in the advance. This chart depicts the Dow Jones Industrial Average against the advanced decline line in the year leading up to the final bull market peak in 1929. What's most striking to me, and hopefully you, about this is the long and wide divergence between the price index and market breadth, where the Dow continued higher while stocks that made up the broader equity universe were falling. The same long divergent pattern that we see here between breadth and price was also evident in the two subsequent, I'll call them stock market bubbles, in the early 70s, which was the Nifty 50, and again in the tech and telecom bubble of the late 90s. Now, if we go to the next slide, please, we'll go through how we measure breadth. In this discussion of breadth, let's just first qualify what it is and what it is not. And probably my biggest gripe with the financial news networks is the confusion between breadth and leadership. For at least probably the last decade, it's hard to go a day without hearing how narrow leadership is. Well, the problem with these critiques is that, as Sam said before, leadership is not the same thing as breadth. Leadership is narrow by definition. How many leaders are there in a business or on a sports team? It's the number of stocks following those leaders that's really the critical part, right? And that's what breadth is. Healthy advances are defined by the size of the crowd of followers, all pulling in the same direction, as Sam illustrated with his analogy earlier. But if the leaders are the only ones pulling the market higher, that's when you've got big problems on the horizon. So Lowry relies a lot on breadth and not prices, because prices alone can be misleading. It's actually one of the things we frequently repeat in our reports. Now, the reason is that the major price indexes are market capitalization weighted, with the exception of the Dow, which is mega cap stocks that are price weighted. So, as is the case toward the end of almost every bull market, investors crowd into what are considered the least volatile, highest quality, or otherwise most attractive stocks. This means that frequently the largest companies end up pulling up the indexes alone, while much of the rest of the market has already fallen away. One of the oldest and I would say least corruptible gauges of market breadth is the advanced decline line, which is just the running tally of the number of net advancing issues. So every day, declining issues are subtracted from advancing issues, and that figure is either added or subtracted to or from the previous day's advanced decline level. Very simple. Let's go to the next slide, please, to examine the history of bear markets and associated advanced decline line divergences. So I studied the complete history of bear markets and breadth from the advent of the advanced decline line in the late 20s. It's not something that was used really back then, but that's when it started. Now, these are some of the most critical points. First, over the last 100 years, 15 of 17 bear markets, and these are classically defined bear markets that if you talk to any technician or anybody in the business, they would say that was a bear market, were preceded by negative breadth divergences. So 90% of the time, breadth divergences warn of an approaching bear market. While all divergences are warnings, those warning sirens get increasingly loud at 4 months and beyond. So that's when you really, really have to start getting concerned about them. And if we look at the table, we see that the longest 3 divergences that I encircled in blue occurred during market bubbles, lasting up to 2 years. From this, we can say that bubbles are historically accompanied by extremely long breadth divergences as these really hot large cap stocks continue to grow, dominating the price indexes. When I put this table together 2 years ago, I ran a regression on the length of divergences to different factors relating to what came next. In other words, the bear markets. The strongest statistically significant correlation was with the length of time to recover to the pre-bear market high. So in that case of the roaring 20s, it took 25 years to get back to even after the bear market. After the Nifty 50, it took about 10 years. And in the wake of the tech bubble, it took about 7 years, and that's using the Dow. It would be a lot longer if we were talking about the NASDAQ, for example, and some stocks that survive still haven't eclipsed those highs 20 years on. The conclusion here is that, and I think the good news, is that if you're paying attention to breadth and not just prices, you have plenty of time to gradually scale out of the way of the most damaging or time-consuming bear markets. Let's please go to the next slide to see where we are right now in terms of breadth. If we compare what we just saw with the current divergences, we see that there are shallow divergences in terms of the number of issues needed to close the gap. And they're relatively short divergences, with the traditional all issues New York Stock Exchange advanced decline line diverging about 2 months now. So you'll also see here a reference to Lowry's operating companies only, or OCO advanced decline line. Starting in the 90s, Lowry re-engineered the advanced decline line to only include common stocks. So not preferred stocks, not closed-end bond funds, for example, had become so prevalent on the New York Stock Exchange version. And before that, the problem was that there are different times, particularly towards the end of a bull market, when the yield curve tends to invert, right? And the traditional advanced decline line started to behave more like a gauge of the bond market breadth, not stock market participation. So, that's why we did that, and that's why we changed that. If we go to the next slide, we'll actually take a deeper dive into breadth. where we break out market capitalization. So when you're taking breadth as a measurement, an even more granular way to do that is when we break out our OCO advanced decline line by market capitalization. And we can see exactly where the weakness is coming from and if or when it is spreading to the other segments. So currently our small cap advanced decline line is in a downtrend, and it has been since June. And that's a stark contrast to the large caps that of course continue to make new highs, while the mid caps are kind of somewhere in the middle going sideways. In the prior side, we also saw that NASDAQ advanced decline line had demonstrated an even longer divergence. And this relates to the overweighting of microcap stocks in the NASDAQ or on the NASDAQ. And most recently SPACs, which began to collapse in February when that advanced decline line peaked. It's worth mentioning too that because of its microcap inclusion or even dominance, negative divergences occur pretty often for the NASDAQ and tend not to be more meaningful than to act as a gauge of small cap health or really risk appetite. In fact, if you take a multi-decade view of the NASDAQ advanced decline line, that would reveal a pretty steady downward bias. And if we talk about small caps and why is that important, historically, given their sensitivity to changing macro conditions and higher overall investor ascribed risk, small caps tend to lead breadth deterioration ahead of market tops. And when you think about it, it makes a lot of sense. Now, while not always so sequential, waning small cap participation typically spreads to the mids and finally the large caps into the final peak. And this is why we often refer to the small caps as the proverbial canaries of the stock market. For now, there is no evidence of major large cap weakness, which means that breadth there is still looking healthy and not indicative of an excessively narrow bubble type environment where you'd even see the large cap advanced decline line diverging. So as a portfolio manager, this means that right now, where you're going to want to be focused on is large caps. And this segmented data is also useful as divergences grow into bubbles to know at what point and in what areas of the market to scale out of. Next on slide 23, we'll look at a couple of other important measures of what I like to call demand intensity. In other words, what is behind the breadth. And these signals also provide ample warning ahead of major market tops. Yes, breadth is great because it neutralizes the market cap bias of the major indexes. But with a fractional gain in a stock, counting the same as, let's say, a 60% gain in a stock on a day, it's really valuable to know what's behind that +1 or -1 in terms of the its inclusion in the advanced decline line on that day. And this is why we measure demand intensity. So in this realm, another feature of bubbles that's also an exaggerated version of what is typical of other market tops is waning internal strength and rising internal weakness. So we measure strength by the percent of stocks near 52-week highs and weakness for the percent down 20% or more. Now, as opposed to what is, I think, intuitive to most people, market tops, especially bubble tops, are accompanied by very few new highs and a surprisingly low number of stocks, or a surprisingly high number of stocks, rather, already in their own bear markets, down over 20%. And you can look at the figures here on the slide, but for example, at the high in the tech bubble, if we're looking at the Dow Jones Industrial Average, that is, only 6% of Lowry's New York Stock Exchange stocks were within 2% of a new high, and more than half, 55%, were already down more than 20%. So I think it's pretty impressive and telling when you see that, and again, counterintuitive to a lot of people. But if you look at what's underneath, it really tells the story and helps you figure out when this is starting to get dangerous. One more note before we move on is if you look at the chart on the bottom here for the percent of operating companies only stocks 20% or more below 52-week highs, know that the scale is inverted. So what you're looking at is an inverted scale on the bottom. And we do that just really to help spot divergences more easily. So when we go to the next slide, if we could do that, we'll look at the current figures just to see where we are. And again, contrasting these readings to bubble readings, we currently don't see the same magnitude or long-term trend of degradation as you would in bubbles. As of the September 2nd, S&P 500 all-time high, both the percent of stocks near new highs and those 20% or more down from 52-week highs stood at around 23%. And to demonstrate the lack of crowding in just technology, if that's what we're really focused on, I looked at the sector composition of stocks near 52-week highs at that point and found that only 7% were tech stocks versus 22% for both financials and industrials, and the next most was healthcare at 11%. Certainly not what you would expect to see if this were indeed a tech bubble. The other difference here, an important point, is that each of these measures spiked to among their best levels of the last decade in mid-March, and spikes like that usually occur relatively early in a new cyclical bull market, with previous spikes of comparable magnitude occurring in spring of 2010 and again in spring of 2013. So with the understanding that bull markets peak on high levels of internal weakness, this activity is actually more consistent right now with what we're seeing to mid-stage cycle. My last slide is next. Is just going to reiterate the most important points. And the bottom line is that though stock participation has narrowed, the current market conditions are not consistent with a market bubble. More specifically, the current negative divergence in market breadth and also in demand intensity are much shorter than those observed in true mania times. And as a result of those short divergences and the limited depth of them, and also the fact that there are so many more small cap stocks than large caps, if we just get a sustained bout of small cap relative strength, that could significantly narrow or even close these worrying gaps down relatively quickly, erasing the negative implications even in the short to intermediate term. So that's all from the perspective of market supply and demand. Up next, with a focus on technology specifically, is Angelo Zino, the head of tech sector research at CFRA.
Great, thanks a lot, Vincent, and hello, everybody. I think Sam and Vincent did an absolutely great job of giving our fundamental and technical views from a market perspective. What I'll do is, to Vincent's point, is I'll focus my comments specifically on the tech and communication services arena. If we go to slide 26 here, you can see tech and communication services make up nearly 40% of the S&P 500. Tech, a much bigger component at 28% of the market. On this slide, you can see that the two pie charts here are broken out by sub-industry for each sector. On the left side here, you've got tech. The biggest sub-industry within there is software at 34% of the tech sector, and that's followed by hardware at 23% of the total. No surprise given that they're led by both Microsoft and Apple respectively. Although semis and IT services, also nothing to sneeze at, with some really big players in each. Within semiconductors, you have NVIDIA now over a quarter of the semiconductor sub-industry, while Visa and MasterCard dominate the services group. On the communication services side here on the right, interactive media and services control 60% of the sector. All Alphabet and Facebook, which together comprise 60% of the sector weighting. And I'd also make one other comment, I guess, on this slide is, we don't break it out by earnings, but if you kind of look at the impact a company like Apple and Microsoft together have on the broader tech sector, it's north of 50%, half the actual IT sector earnings. So these companies are actually representing even kind of bigger percentage of the earnings potential of these sectors because of how profitable they are. Moving on to slide 27, this just takes a look at the performance breakdown of the sectors versus the S&P 500 and then by sub-industry. Through September 5th, tech has performed relatively in line with the market, while communication services has really been a notable outperformer. And you'll see in the coming slides, it's really being driven by Alphabet more so than anything. So tech has really performed well across most sub-industries year to date, with services and hardware as the laggards. Software has really been the place to be, especially since May and the post-tech with the post-tech rec, and then the Q1 sell-off thereafter. And also, I'd say the pullback in yields also helped alleviate a lot of the fears that some massive spike in yields would dent the growth of some of these kind of cloud-based stock multiples. When we kind of look at on a 3-year basis, we can see hardware, software is the biggest winners. Of course, again, led by Apple and Microsoft. And semis have also done very well. The move in semis, especially noteworthy, as Intel was really the biggest component until last year, which has held the index from doing much better than it could have. On the communication services side now, year to date and over the last 3 years, interactive media and services has been the place to be. Alphabet, Facebook, and Twitter, the 3 names within that sector. And entertainment segment I'd also highlight includes Disney, Netflix, and the gaming players. They've done little until recently, at least on a year-to-date basis, and has slightly underperformed the S&P 500 over the last 3 years, while the telcos have been a notable disappointment. Moving on to slide 38 here. Sorry, slide 28. I think this is just a great illustration of just how tech has performed over the last 20 plus years versus the S&P 500. So tech is that orange line, while the S&P is the blue line. And if you held tech since 1998, you'd be up about 1,000% versus about a 300% plus gain for the S&P 500. And that assumes you didn't get shook out during the tech bubble and during the financial crisis. Now, I break down the history of tech, or try to do so over the last 20 years, into 3 phases. During phase 1, which I highlight from 1998 to the 2009 lows, IT was down more than 60% from the tech bubble highs to the financial crisis lows. And during that phase 1 time period, tech multiples were compressing as we kind of saw a changing of the guard away from some of the bigger players, the big boys out there, the old school tech companies like Intel, IBM, Cisco, names that you saw in Sam's kind of earlier top holdings list in 2000, to more mobility type plays over that time, specifically a name like Apple. Now, as we exited the financial crisis in 2009, smartphones were still extremely underpenetrated, with less than 1 out of 5 people owning a device. Here in phase 2, you had 3G, 4G becoming more readily available globally, and this was when Apple, with its iPhones, and Alphabet with their mobile ad business, you had the e-commerce platform from Amazon, Netflix, chip makers, and a host of other mobility beneficiaries like social media companies really starting to garner much attention. Companies like Intel, Microsoft, and IBM were initially kind of punished, left behind by investors as they were scrutinized for missing that mobile revolution. However, kind of as we progress through the decade, 2013 to the 2015 timeframe, the opportunity for the Microsofts of the world and other tech behemoths in the cloud really became apparent. And since there's really been no turning back. So the opportunity in the cloud just really got bigger and bigger, with AI really unlocking the cloud potential, which you can see here in phase 3. And now COVID last year has only really accelerated those opportunities in the cloud, as we can all see in our day-to-day lives. So I think the question now is, after looking at this parabolic move in tech over the last few years, are we ready to come crashing down, or is this recent move sustainable? And I'll try to provide some context in the coming slides on both the fundamentals and valuations, but the fundamentals are absolutely real and we think here to stay. If you go to slide 29 here, this is just data on what we always believe to be the most important driver to higher stock prices, and that's of course higher earnings. So communication services this year has been a big beneficiary on the broader reopening play as ad spending picked up. In that top table, you can see the big bump in earnings growth for 2021 from February end until early September. That's also boosted the 2022 estimates. So for comm services and tech, the 2021 growth estimate was about 13% and 14% back in February. Now you're looking at earnings growth of 37% and 30% respectively. Exiting 2021, I'll say that IT and comm services, we think, should be kind of viewed as better plays as these cycles mature. So reason being, historically, you kind of get these higher growth names with recurring revenue streams that should be able to outgrow other cyclically oriented sectors, especially as kind of the earnings bar goes up further into the cycle. Now, looking at the bottom table, this just looks at the 7 largest weighted components in the 500. Shouldn't be a surprise that Alphabet has seen the biggest earnings surprise since the end of February, and that's led, of course, to a sharply higher stock price at over 60%. NVIDIA, the best performer here year to date, though, number of reasons, but really started breaking out after the analyst event in late April, when they started really diving deeper in some of the opportunities in the cloud, like their expected entry into server CPUs. That's going to be in 2023, a growing backlog for autonomous cars. But maybe most important, they did announce a 4-for-1 stock split. And I think you have some investors maybe trying to get ahead of NVIDIA potentially getting added to that price-weighted Dow 30 index at some point in the future, similar to what you've seen in the past with Apple. And then I guess the other thing I'd make a comment on, Microsoft's multiple here also expanded in recent months, despite the fact that the earnings hasn't grown as much as some others. It just reflects a number of things, I think, going its way, including a recently announced price hike to its Office Cloud offering. That'll take place in 2022, and I think that gives investors reason to believe that estimates will continue to be nudged higher. So if we now move to the next slide, slide 30, kind of look, while the concentration in the S&P is definitely high on the tech side of things, and it could be viewed as a risk, we also make the case that it has the potential to reduce market risk, and likely has done that just over the last decade. And it's of course impossible to predict the day-to-day actions of the stock market, but those that kind of believe that the big tech run is near its end, we think are probably misguided. And there are a ton of disruptive trends on the horizon where companies like Apple, Microsoft, and Alphabet have their tentacles to really drive earnings growth significantly higher over the next decade. And this chart just looks at 10 of those disruptive trends, some much earlier in the process than others. And we could have kind of an extremely long conversation speaking about each of these topics and the opportunities that lie ahead for each. Some of these disruptive trends, though, include AI, VR, augmented reality, and the AR side of things, an area Apple is putting a lot of emphasis on. You've got cybersecurity, you've got edge computing, which includes themes like autonomous vehicles. On the comm services side of things, we do highlight 5G, kind of streaming, and topic we also highlight is the Internet of Behavior. That's a new emerging theme that Gartner has highlighted for 2021. I think a company like The Trade Desk is a great way to play that trend, just as a quick plug. Many of these trends in communication services will, of course, overlap in tech and vice versa. So, for instance, 5G clearly has an impact on Apple and the chip makers within tech, while both Apple and Facebook comm equipment players are working on greater AI capabilities within their ecosystem. So, definitely let us know if you have any interest in our tech team diving deeper into any of these topics in the comments section, as it really helps us gauge interest for future presentations. One other final point I'll make here, as you can see, these trends all lead to one bigger trend at the center of the slide, and that's more data. More data will be created in the next 3 years that's been created in the last 50 years. And these trends will be big contributors to that, with machines really doing most of that data creation today. And while this data needs to be stored somewhere, usually in the cloud, what's really fascinating is that less than 2% of that data is actually being used today. The next slide here, slide 31. So among the big 7 companies previously highlighted, we highlight the biggest risks into 4 quadrants. So on the top left, you have the regulatory overhang risks here, largely big and ignored, given a long tail, but needs to be considered, especially after the run these stocks have had. So you got Alphabet, Apple, Facebook, Amazon. They've all got to contend with antitrust issues related to their business practices that accuse them of negatively impacting the competitive environment. And I'll go more into that here in the next slide. You've got NVIDIA, which will have a difficult time, we think, getting approval for the ARM deal, while Tesla will at some point see greater scrutiny as autonomous vehicles finally become a reality. Ironically, Microsoft actually best positioned here from a regulatory perspective in our view. That said, our view on the regulatory front, though, maybe key takeaways, you'll likely see regulators try to curtail certain business practices rather than force a breakout of any of these individual companies. At least that's what we're looking at. Now, the second risk here, geopolitical. I've listed a slew of some of the geopolitical China issues for tech and the comm services space, and there are absolutely real concerns for many tech companies related to China. However, many of these concerns we think are actually positive for the stock prices of big tech. So, big pension funds, other investors out there have to mitigate the risk on the geopolitical front, and they've done so by selling companies like an Alibaba and Baidu. But these funds will invest in some of these bigger tech names that have very little exposure to China, like an Alphabet and a Facebook and a Microsoft. And Apple, which also is viewed as heavily China exposed, actually taking tons of market share at the high end of the China market due to weaker competitive threats from competitors being added to that exemption list. Third risk I'll highlight, cyclical. You got the hardware semiconductor names appear to be running above trend line. And that, you've got uncertainty about what the normalized long-term run rate will look like. PCs and tablets, a good example, and potentially some areas of semis where we're likely seeing customer inventory maybe starting to build. As backlogs in these industries start to come down, risk will increase. And the bar for the next iPhone cycle, also I'll highlight, looks like it gets very tough as we start going into that March quarter. And then the final risk, valuation, of course, we highlight that of course, interest rate spikes have short-term disruptions in growth names, while a deceleration of growth also has a potential cause of concern for some of these elevated multiples out there. Go to slide 32 here. So I'm, by far from a legal expert here, but with the help of our Legal Edge team, we do try to illustrate a timeline of some of the biggest issues among the big tech players, and the situation is getting more complex. Apple has been at the center stage here with its battle with Epic Games that saw California rule on the trial last Friday with an overall mixed outcome in our view. So while the court said that it doesn't view Apple as a monopolist, it did conclude that Apple's anti-steering provisions hide critical information from customers. So the outcome we do think it sets the stage for future legal battles with other developers and antitrust authorities. And when we think about there's still concern about Apple's 30% commission fees, as well as Apple's royalty agreement with Google, which we estimate to be at $10 to $12 billion, and it goes straight to the bottom line. And that's part of a bigger DOJ lawsuit that's targeting Alphabet's search distribution business, where Apple's search partnership is a key aspect of that case, and that's expected to start in 2023. Congress also taking aim at big tech through a number of bipartisan bills looking to rein in Facebook, Alphabet, and others by trying to curtail some of their capabilities of their online business practices. Our legal team, for instance, has highlighted the Ending Platform Monopolies Act, which would bar Amazon from competing with third-party sellers. And you could expect to see more traction on that subject as we go into 2022. And then we also highlight other issues, including a refiled antitrust lawsuit of Facebook. So the bigger question, I guess, is what does the regulatory landscape mean for big tech stocks? And I previously highlighted, Microsoft probably by far in the best position here. Apple, in our view, has the most at risk given the recent multiple expansion we've seen. Any major change in the regulatory environment for Apple, such as a change in their fee commission structure of 30%, would have an adverse impact on the growth trajectory of their services business and likely its PE multiple. And just for everyone listening, currently we're modeling zero growth from their combined iPhone, Mac, and Mac segments over the next 2 years. So all the muscle really coming from services and wearables. So this thinking also coincides with our legal team in that they view Apple as having kind of the most significant degree of mispriced legal and policy risk. Now, I'd also say from a risk perspective, then, place Alphabet, Facebook, and Amazon right behind Apple, given the perceived monopolist actions that they have demonstrated by some regulators across the globe. And in my view, you can argue that the way these three companies do business do showcase monopolist behavior, whereas to a much larger degree than Apple does. So if we just kind of shift now to slide 33, just shifting gears to valuations. This is just a look at the forward PE for the tech space since 1999. As you can see, multiples today around 28 times in the next 12-month basis, nowhere near the near 60 times multiples seen back at the tech bubble top. Multiples, however, have absolutely expanded since the financial crisis lows within tech. and are around the highest levels we've seen since 2002 to 2003. We've also seen multiples kind of, really be stuck here since the peak in September of last year, when it peaked at 29.6 times. That was during the euphoric moves, if some of you recall, of both Apple and Tesla after they announced stock splits. Since then, kind of the PE for broader tech has ranged closer to 25 to 28 times. And now let's move to slide 34, just to dive a little bit deeper into the valuation and whether we think the multiple expansion has been warranted, and we do think it is. So on the bar chart on the left, you can see how multiples have expanded for tech and comm services over the last decade, which has had a direct upward impact on multiples for the broader S&P 500. So the PE for IT, based on 2021 and 2022 earnings, here is shaded. It's trading around 28 times and 26 times respectively, and well above the 5-year historical average of 20.5 times in orange there, and the 10-year historical average of 17.5 times in blue. Now on the right side, you have the current PE multiples for the big 7 and how they've done compared to historical measures. And the ones that have seen the greatest multiple expansion and impacted the markets the most, I'd argue, is Apple and Microsoft. In Apple's case, it's been a shift to services that's created a more recurring-based business model. It's improved their long-term earnings profile, of course, while mitigating the iPhone cycle volatility. And services, of course, have 2 times the margins of hardware, and this has positively impacted the multiple. And in Microsoft's case, this is a company that's seen its multiple go to about 36 times this year from just 13 times 8 years ago. Now here, shifting away from a licensing model to, again, a more recurring-based strategy focused on the cloud has improved its margin profile. And the situation seen from both Microsoft and Apple are examples, we think, of what we have seen across the tech space in recent years, essentially creating more recession-proof business models. It's because of this, in our view, that you're unlikely to see some massive scare in terms of multiple compression for these big tech bellwether names in the coming years. We actually believe the changes to these business models have had a permanent positive impact to the multiples in tech, and we don't expect any sort of reversion anywhere near to those multiples that you saw 3 to 5 years ago. Now, if you just shift to slide 35, this will be my last slide. So kind of looking at recommendations, we have a strong buy recommendation on 5 of the 7 biggest S&P contributors that represent a quarter of the market. I won't go through the rationale for each, but Microsoft has been our favorite name. It's a strong buy recommendation among this group. Alphabet, to us, looks the best positioned given its valuation and their actual earnings growth trajectory over the next 3 years, despite the recent run it's had, especially if they can hit on one of the many, many moonshots that they have out there. Now, for longer-term investors kind of looking out over the next decade, NVIDIA appears to have the greatest, at least top-line growth potential, and probably my favorite name on a longer-term basis. And among the names we're currently recommending, Apple, likely the riskiest over the next 9 to 12 months, just given the regulatory uncertainty we highlighted and the higher bar that it will need to hit within kind of their core hardware business in iPhones, Macs, and iPads. And with that being said, I'll leave it at that, and I'll pass it over to Todd to go into ETFs.
Thanks, Angelo. Great to follow you, and I'm going to cover technology from an ETF perspective as well as some others. Let's just jump to the next slide if we can, just as a recap to the way that we at CFRA are focusing on ETFs as well as mutual fund research. We take a forward-looking approach to analyzing ETFs. We take Ken and Angelo and the broader fundamental researchers team's view of the underlying stocks that you saw earlier. We blend that with some forensic accounting research, and we leverage those capabilities, combining that with our proprietary data to look forward as well as look at the track record and the cost of a respective ETF. So we'll move forward. We'll dive in specifically into some of the ETFs. On the next slide, we'll look at the broader market of the S&P 500. I'm using SPY as my proxy. This is one of 4 S&P 500 based ETFs, but it is the largest. And we're using Invesco's S&P 500 equal weight ETF, RSP. We talked about the importance of breadth. Well, if we do see breadth, then we're going to see a more equally weighted approach perform well. You can see the notable differences from a stock perspective, with Apple being a significant weighting in the S&P 500, on a cap-weighted approach as opposed to an equally weighted approach. Information technology that Angelo talked about in depth of being the largest sector, but only being 15% of an equally weighted approach, whereas utilities is a double weighting within the equally weighted approach. And you can see the differences in the track record, but on a 1-year time frame, it's been better to have an equal approach, which basically holds the same S&P 500 stocks, but in equal amounts. So roughly 20 basis points in each of those respective stocks. That's why you see Apple at a 20 basis point weighting. Let's move one slide forward and let's look at the technology sector. Specifically, you can see again XLK, which is tracking the S&P 500 technology sector, is heavily weighted towards Apple. It has much smaller weightings in much more moderately sized companies like Monolithic Power Systems, and how it's performed on a 1 and 3 year basis. The second product is an equally weighted version, again, using the exact same stocks within the sector, but treating them the same and then rebalancing as appropriate. And Apple is actually a smaller weighting than Monolithic Power Systems in the equally weighted approach when we ran the data at the end of August. And you can see an equally weighted approach has been better over 3 years, but not as strong on the past year. And I want to touch on one last sector on the next slide. Vincent talked about healthcare in particular as being one of those areas where breadth is different. And you can see here, the equally weighted approach, RYH, this is Invesco's product, again using the S&P 500 as a starting point, has been the stronger performer on both a 1 and 3 year basis. And you can specifically, we've called out ResMed and Johnson & Johnson, ResMed being 1/10 of the overall size from a market cap weighted perspective, but actually has grown and performed better and is now an even larger weighting. So it's important to us at CFRA to look inside the portfolio and decide whether or not, if you're looking at sector ETFs, an equally weighted or a market cap weighted approach makes the most sense for you. There's certainly going to be risk and reward trade-offs. With that, Ken, I'm going to hand it back to you. I'll move us forward one slide to take some questions.
Thanks, Todd. And we're going to take 10 minutes, so we'll go past the hour to get as many answers to questions that you all have. I'm going to start with Sam. If the cap weighting of these two largest sectors is not a good correction timing tool, what do you think is?
Well, I think first off, we have to realize that I've not met anybody that has a foolproof indicator that will warn us of either corrections or bear markets. And the revered John Maynard Keynes was attributed to having said that markets can remain irrational longer than short sellers can remain solvent. That said, sometimes just simply looking at the duration of an advance can help one to realize if we are long in the tooth. The current advance is almost 3 times as long as the average time that the market advances between declines of 5% or more. It is actually the 9th longest since World War II, so it does indicate that we are certainly much closer to a decline than we are to the beginning of a new advance.
Sam, you've been right on the market. Other strategists haven't, particularly from some large Wall Street firms. And this week, you know, in the media, it seems every strategist that got it wrong is talking about a correction. So from your perspective, could the market fall into a correction or worse yet, a bear market?
I think it could fall into a correction based on the work that Lowry does, based on the other indicators that we look at. I think it would only be a correction and not a new bear market. I think when we look to what typically happens is that sectors and broad benchmarks tend to challenge their 50-day moving average first. The S&P's was only 15 points below where we closed yesterday. So we could be, in a sense, testing that 50-day moving average, which has held up with the prior challenges over the past many quarters. Should we break below that 50-day moving average, then we look to the 200-day moving average, which ends up being sort of the line in the sand between a pullback and a correction. Pullback being 5 to 10%, correction being 10 to 20%. What I have found is that when we do fall into corrections, it's those sectors that have had the 3 highest differentials between their current index value and their 200-day moving average, as well as the 10 sub-industries that are furthest above their 200-day moving average. These are the ones that on average tend to fall more than the market. But that's common sense, because if you have more gains, then you therefore likely see people willing to take those gains quicker than stocks that have not done as well.
Thanks, Sam. And Vincent, was there any warning in the Lowry indicators ahead of the COVID crash of 2020? Large event, perhaps unexpected, or something you saw in the indicators?
Yeah, no, it's a good question. So it was an interesting case, because I think it was the truest real crash that we had seen. I mean, I would argue since '87, but even in '87, you had a long divergence before that quote unquote crash. You know, yes, there was a crash there, but there was plenty of warning ahead of time. That one, so in 2020, we did see about a 5-week divergence. It showed up in breadth, and it showed up in our OCO advanced decline line. But interestingly, it did not show up in the all issues advanced decline line. I think this kind of underscores what I had mentioned earlier about the sensitivity to kind of bond issues more so than stocks. And the reason why we saw the divergence with our advanced decline line was A, because of the interest rate sensitivity of some of the issues they're including, but B, because small caps did their job again, right? They, like we talked about earlier, they are the ones that stopped working in about early January, well ahead of time, and they caused the divergence. But we also saw divergences in, for example, some of the longer term momentum indicators, like the percent of stocks of their 50 and 150-day moving averages, and in some of the demand intensity indicators that I mentioned earlier, with the percent of stocks near 2%, near 5%, near 10%, and those down 20% or more. So there were a bunch of divergences that warned us. They were just really short. You know, they were only about 5 weeks long in most of those cases, and emanating from the small caps. Usually when you get small or short divergences, you tend to have shorter recoveries from them. And that kind of makes sense, and is sort of a contrast to what we see with bubbles, where this, if a market topping is a process, then, you know, bubbles are the biggest process, because there's just so much going on there, and you know, so much confusion, I think, toward the end.
So one thing in your presentation, the small caps is almost like the canary in the coal mine. Yet for many investors with portfolios, it's a small percentage, or it's like emerging markets. It comes and goes. So would you say that's a conventional view from technical analysts, that small caps is an important metric?
Yeah, no, I think it's I think it is somewhat conventional. I think there's a lot of meaning there when you think about, and I touched on this earlier, why it's important. You know, why they're important. They're not just important because they're small caps. I mean, people don't really care too much about small caps, but in terms of the signals that they send and the way they sense changes in risk appetite, and then their impact on breadth is so outsized relative to their, you know, to the way how they're invested by people. I think that's really their importance.
Great. Angelo, so as growth rates start to normalize in the tech sector in 2022, what impact do you see that having on big tech names? And certainly you showed it's not like when we had Cisco trading 70 or 80 times back in 2001, but the law of large numbers, you know, Microsoft or Apple, I mean, how much do you want to pay for these stocks?
Yeah, no, I think that's a good question. I think that, you know, the big question, Marco, is you know, what's the right PE multiple for big tech? And the answer is it's impossible to tell you what that number is. But when we kind of think about big tech here, there's reasons for it trading where it is, right? So big tech names make you feel safe. They've got these reoccurring based business models, and, you know, as we kind of exit, you know, some of the early stage cycles, big tech, I think, from a growth perspective, will start looking a lot more favorable versus a lot of the value-oriented names. But I think what's most important based on what we've seen here over the last 2 years, because that's really where we've seen a huge amount of kind of the upside to the multiple expansion and the performance in these stocks, is, take a look just at Apple 2 years ago, right? You look at Apple 2 years ago, we were forecasting free cash flow of that company annually of about 60 to 70 billion a year. You kind of forward now 2 years later, and we're looking at annual free cash flow of $100 billion plus annually. And I guess what I would say is the pandemic has clearly changed the game permanently for not only Apple, but all of these big tech names. And it's kind of, when we extrapolate over the next kind of 10 years now, you're looking at Apple generating over $1 trillion in free cash flow. And when you think about a $2.5 trillion value market cap, doesn't look overly expensive. So you've got to have more of a longer term view when you're looking at big tech and tech in general. And if you do so, it actually doesn't look as expensive as what the PE makes it out to be today.
Yeah, and maybe there's breadth in some of these names because it's not just growth investors, but growth and income. One quick question for you, Angelo. So when we look at ARM Holdings and NVIDIA, Qualcomm, I think made an attempt, and certainly if the deal falls through with SoftBank, they want to participate in some way. Why is it so hard to get through regulation with ARM Holdings?
Well, I mean, I think it's just the type of IP that they control. ARM Holdings essentially has the most valuable IP within the semiconductor industry, and NVIDIA acquiring ARM Holdings would essentially kind of throw a ton of other tech companies up in arms. Not only companies like an Intel and Qualcomm, which use to some extent ARM-based IP, but it would also throw it would also have the disapproval of the likes of the Alphabets and Facebooks of the world also, which are more and more designing their own chips these days. So when we kind of think about kind of the M&A environment and specifically that transaction in general, the amount of regulatory hurdles not only in the UK and Europe, but and not China as well, but here in the US as well, it's just there are just going to be a ton of hurdles for them to have to go through in order for this deal to be done. So we've told investors that at the very least, don't expect anything until the end of 2022, but we're now looking at probably more than a greater 50% chance, and likely and probably unlikely this deal getting done.
Great. Todd, last two for you. Can you explain how often equally weighted ETFs are rebalanced and whether this causes capital gains to be incurred?
Certainly. So equally weighted ETFs are rebalanced on a quarterly basis. So 4 times a year. There will be times when the stock will obviously drift and be a higher weighting within the portfolio or a lower weighting, and winners are sold and lagging stocks get added to. This happens to be done in a non-taxable way through the ETF structure. And as such, historically, equally weighted ETFs have not passed along any capital gains to existing shareholders. I don't want to get too far in the weeds on this, but there are no capital gains implications for shareholders that hold on through the rebalance period.
So, as we kind of look through ETF funds, is there any that take an equally weighted approach, but the fund is not labeled as such?
Sure. So the industry-oriented ETFs, many of those happen to be equally weighted. So, for example, there's a Spider S&P semiconductor ETF. The ticker is XSD. And this one gives you exposure to small, mid, and large cap semiconductor stocks. Equally weight is not in the name, but that's what it does. It holds the same amount of money and heavyweights like NVIDIA that Angelo was talking about as these much more moderately sized companies within the space. So you have to look inside the portfolio, not just judge it based on the name of an ETF.
Great. Nicole, can we go to the next slide? So certainly I want to thank our presenters for what I thought was a very interesting and comprehensive review of market concentration. Great job, everybody. And thank everybody on the call. Next slide, please. So always, if you want to learn more about CFRA or about how to get our research, you can visit Market Scope Advisor. Also, we are offering Lowry Research Trials. I did mention it was earlier this year acquisition by CFRA. This is a great team, obviously showcased here today by Vincent. And we are offering a free trial, as you can see here as well. Most important, we want to thank you again for your valuable time. Stay healthy and look forward to our next CFRA webinar with you. Take care.